All right, welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we're gonna discuss something juicy. Recently, Warren Buffett has sold quite a large position on his Apple holdings. So today we're gonna discuss with you what is the news. So why did Warren potentially sell his stock? What might his next place be? We're gonna look into the fundamentals of Apple. We're going to look at some important ratios and how they are performing in the market in general. And after that, you're going to get a valuation based on our assumption, of course. So, again, as we always say, it's not financial advice, your own due diligence, but you're going to have some kind of idea of what Apple should be worth. So, Kirill, take it away. What is in the news?
Yeah, let's get started. So, our lovely gentleman, Mr. Warren Buffett, was 3 months ago saying that, yeah, we're just trimming down our Apple position a little bit, just a little bit, just because of, the tax situation, because he assumes that the corporate taxes are going to be increasing in US potentially, so he wants to, lock in some gains, which is understandable, which makes sense. You can trim down, especially in your biggest position. But then, if you look into how much our lovely gentleman is selling nowadays, he has reduced his Apple position by 55% from 905 million shares in December 2023 down to 400 million shares. So that's something which calls up for the question, why is he selling only Apple so drastically? Because he could also sell, for example, American Express. He could sell Coca-Cola. He could sell any other stock, right? If he wanted to just, get some of lock in the profits from the investments. That would completely make sense. But now, when you also check another news coming on CNBC, it says Warren Buffett now owns more treasury bills than the whole Federal Reserve themselves. That was the news from yesterday. So literally what Warren is actually doing is not just looking at profits, but he's actually increasing his cash pile. So what's happening right now is that he is buying the short-term treasury bills, which are, having the yield of around, I think, 5% more or less. And he's just piling up on cash. So if you would see that his war chest is already almost 300 billion US dollars. So it feels like something bad is happening in the eyes of Warren Buffett. And and then it also calls for the question once again, why is he also selling specifically Apple stock?
Yeah, exactly. And, this is something that he has been doing previously, right? So whenever he cannot find really good deals or something, he's known to really stockpile on cash and only puts it to work when he really has the confidence that it will go somewhere. So, but yeah, like you said, Kirill. So why is he setting Apple specifically and not other one of his other holdings that also have major representation in his portfolio? So why don't we just pull up the 930 web app and we can look into it?
Yep, here you go.
All right.
Yeah, so basically, this is our new web app, which is soon gonna be in production, hopefully, within a month or two. And we're just gonna, as Robin mentioned, just check the valuations, check what could be the potential reasons why Warren Buffett would be selling it, right? And then actually try to understand and answer the question like, is Apple stock actually worth 210 US dollars now, or is it worth more or less? So yeah, let's get into it.
Yeah.
Huh?
Yeah. All right. So I don't think we have to get into the company. I think we have a clear idea of what Apple is selling and doing. But we can look into their regular finances, so we can already see that they really do not pay a dividend. Yeah, which is fine. It's okay to keep things internal, so nothing wrong here. Yeah, we can see a PE ratio of 29. We discussed in our previous video that the average of the tech industry is around 34. So this signals that it's probably on the cheaper side of things, but we'll get into why that might be. They do have a high gross margin and a high operating profit margin, which is really good to see, right? And it's also something that you would expect from Apple because their prices on the products are pretty intense for what they're producing it for. So these are not surprising statistics, but we can check it out further. So for the company foundations, we just see green across the board. So we see revenue growth, it's on the low side, right? It's 8%. The long-term debt is covered by free cash flow. They have been growing their net income consistently. Their cash flow has been growing consistently. They have been buying back shares at, what is that, 4.5%, which is quite some ways, and really good to see. Of course, the other way around, you wouldn't want to see when they start diluting you, and it is also good because they don't pay a dividend, but you see that they have really, they trust in their own business and they just keep buying more shares of that. And then the average dividend growth is almost 2.5%, which is fine. Like I said, I like the number of the buybacks more than the dividends.
Yeah, that's the also the fun part is that you can see now that everything, you get the green checks all the way, right? But when we're gonna go further, it will turn out that all of these green checks are not really sustainable, and we're just gonna dive into it further when we're gonna discuss the revenue and the debt situation of the company.
Right. Yeah, we can just quickly go past these key financial results. Just as we expected, and we seen before that profits are rising, revenues rising over the years. But is there selling and general expenses? So that has been rising as well. Looks as it been rising with gross profit and revenue. So nothing major there. See, all these things have all some kind of a correlation which you would expect. Is there anything you want to cover here, Kirill?
Only thing is what I'm again, like what I wanted to say, even though you say you see that the average growth rate over the past years have been around 8%, so we're talking about the past 8 years, the growth has disappeared after 2022 because the higher interest rates, again, maybe the economic environment is also not doing so well, so people, even though they all like Apple products, they love them, there's a lot of fans of them, and completely understandable, they got great ecosystem and everything. But if people cannot afford very expensive tech, or the tech is actually not, being updated so frequently with some very very great updates, great features, great software, hardware, then for some people the question arises like, what's the point of even upgrading? If iPhone 15 is going to be the same as 16, 17, and so on and so forth. So,
and I don't know if this is still true. It's been a long time since I've been looking into Apple products, but if I recall correctly, the Apple 6 has still been getting regular software updates. So imagine we're now at like 15, right, and all the way back to 6 is still being updated on software, which basically means that the hardware can still handle the daily tasks. And I think it's also the reason why it has not been rising as much. For example, the revenue, like people don't want to buy a yearly phone anymore. I mean, the hardware is barely changing, and you can only put so many better versions of a camera on it. RAM can only increase so much, and especially on a phone. So yeah, of course they have been developing new chips for their MacBooks and whatnot. But yeah, just like you said, Kirill, like at one point just hardware reaches limits, and then it becomes about being more efficient.
And also on top of that, of the ways how Apple was growing its revenues mainly in the recent years was about it was fully based on services. So all the Apple insurance products, any subscriptions for Apple TV and so on and so forth. These services and products, they are way more lucrative because a lot of them are subscription based. So they can actually grow it further. But then again, you're gonna hit the ceiling with the fact that all the people in the world who actually wanted to get Apple, they already got it. So it's really hard to actually find more people to get to your product unless you're gonna discover a new niche, like we just discussed before the video. Like for example with Nvidia, right? They discovered the niche with AI, and they provide the graphics cards for that specific purpose. So if Apple could find that new niche where they could dive into and then again capitalize a lot, that there's nothing wrong with that. But for now, for the past many years, Apple is being stagnating when it gets to finding like something new, that new gold mine kind of thing.
Yep. All right, so let's continue to the ratios and just see how it performs besides growing revenue.
Yeah, and also maybe just to quickly add up on that, So we also, if we check, like for example, the interest expense and the total liabilities, so including the long-term debt, it doesn't look like they are, for example, decreasing in offloading debt so quickly, simply because they probably got the debt during the COVID times when the interest rates were low, which is understandable. That makes sense. Easy, cheap debt. You can afford it. You can buy it. And a lot of it is then used for the share buybacks because Apple is also famous for their share repurchase programs, and that's what also Warren Buffett really likes. But then it also again calls for the question: is that sustainable when you load up on that just to buy back your own stock, which could be potentially maybe overvalued at some points of times, could be undervalued. But when you're spending billions on the buybacks, which you could have been potentially reinvesting in any other like lucrative money making opportunities, then why? The question is why? Why is that happening, and why not using that for better use?
Yep.
So it might sound like I'm trashing Apple. No, don't get me wrong. It's just more like just asking the questions which I'm genuinely curious about. So if I would be like Apple, and I would start accumulating a lot of debt, there's got to be some good reason behind it, or got to be some good reason behind buying back your own stock. So is there something, for example, Warren Buffett likes to see because he was a major shareholder, or maybe something else? Nobody knows. But then it's also a question of maybe doing your further due diligence on that one. Yeah. But yeah, I think I got a little bit drifted away. So shall we move on to the key ratios?
Yeah, we talked up at the key ratios.
Yeah.
So here we can see the net earnings ratio, as we mentioned, it's above 20%. Good. Then we look at the research and development ratio, and I see that that is around 20%-ish, which is also good to see. So, they're just running on their brand. They have this mode, even though their technology doesn't have to be top-notch, let's say, to be sold to their fan base. It's just the Apple logo carries a long way. Then we can also please go down for the selling and general expenses, also below 20%. Again, the brand is really selling itself at this point. Well, not really selling itself, but compared to other companies, it's good.
Yeah.
Is there something else you want to highlight here?
Yeah, good point. Yeah. So the things I just wanted to highlight, right, is again just the revenue growth, the free cash flow growth, and the net earnings growth. They have been all stagnating for the past 3 years, and they are being quite sad to say the least, right? So you got 8% growth 2022 for revenue, -3 2023, and so far it's more or less zero now. And it's of course reflected in the free cash flow and net earnings. And then again, it's just calling for the question: why would you need to load up on that to buy back your stock when you're not making enough money to actually support that? Or even if you do, why would you not reinvest it in the business again and make the revenue growth come back? Just to keep on growing how you have been previously. So yeah, that's a little bit of a sad story when it gets to that. However, when it gets to, let's say, the current business, as you mentioned before, return on capital employed is great, 42%. Gross margins, operating margins, everything is one of the best, let's say, metrics as you can see on the market. No doubt in that. So it's, as you can see now, to be honest, it feels like Apple is more of a cash cow kind of company.
Yeah.
So it's just there. It's very big. It's too big to fail, but it doesn't look like it can continue growing as it was a few years ago.
Exactly. All right, and then we go to the valuation.
Yes, sir.
So let's get there. So we see the points, of course, that we need to fill out. So we can just use the free cash flow from last year.
Yeah, for sure. So that was around 100 billion. That's of course insane.
Yep.
That's just insane numbers. No doubt.
And then
about
also
that.
for the projected period, like either 5 or 7 years, like you said.
Yeah.
It's just one of the biggest companies there is. So it just takes a lot to wipe it off the surface, basically.
Yeah.
The discount rate, we keep this usually at 10%, but of course, feel free once this sheet is, or no, not sheet, web app is
Yeah. Again,
is
like last
is
time, huh?
yeah, is available for purchase. You can of course play with this for yourself.
Yeah.
Okay, so we can see the estimated growth rate. So I see here on Yahoo Finance that the analysts think that it's gonna grow with 20%
Wow.
per year in the next
Wow.
5 years. So just a quick look at you know the average growth rate has been 9.5% in the past,
Mm-hmm. Well, for the
and
past
the
five
same
years,
for
yeah.
and the same for the free cash flow, right? So
Yeah.
what is there something that the analysts know what we don't know, or is there just too much hype in there? What do you
Because
think?
yeah, the question is, let's put it like that. When we're talking about the new things for Apple, right? So we heard about Apple Car. That was a flop. That didn't work out in the end, so they canceled that. They wanted to develop their own AI. So far, the news say that they're gonna partner with OpenAI for that reason, and probably include their new GPT search soon. So that also doesn't look like they will do that in house. So I also don't potentially see any fruitful business that is gonna come up soon within the upcoming 5 years that will say like, yeah, Apple is gonna make a lot more money because they're already in free cash flow. They made $100 billion. How can you grow that with 20% growth rate yearly?
Crazy.
Yeah,
Yeah,
that's
it's
a little
insane.
bit strange. That doesn't make sense to me, honestly.
So what I would do is just give him the 9% that I've been doing for the past 5 years. And like you said, and like you showed, like for the past year, they have not even met that number.
Yeah.
So
So
crazy how they think that they will manage to match that.
I would
Okay.
also say, yeah, even these 9% for revenue and free cash flow growth, they're mainly based on the first 4 years, that we have in the tool. So the last and most recent 4 years, they have been very stagnant. So we would assume that, let's say, it's going to be more or less similar for the upcoming 5 years, but I would even say it's going to be close to zero. I'm not even talking about maybe negative numbers to be realistic, let's say.
Yeah.
But we just for the sake of the exercise, we can just put it 9%. That's completely fine. Let's
Yeah.
just stick with the basics, let's say.
Exactly. And I'm also just quickly checking out the breakdown of the revenue of Apple, just to
Mm-hmm.
see, like you said, like services is one of the, next to iPhones, it's one of the major revenue drivers, and then you have Mac and iPads.
Yeah.
And wearables. That's just, yeah, uh, yeah, it's just basically more of a story is there's a lot of iPhone there that's driving revenue, and the question is, of course, like we mentioned said before, like how much more iPhones can you ship out, and yeah, basically. So again, the 9% is pretty good. Just leave it at that.
Yeah.
Uh, the projected PE ratio, we can use the average, which is 28, which is not that high. It's around the PE that we have now, I would say. So you can just use that.
Yeah, the thing is, what also good to keep in mind that we can put it 28, but also it's also really the question about the economic environment and the interest rates, right? Because for the past more than 10 years, globally in the developed world, we enjoyed very low interest rates, right? So that's why if you cannot park your money in deposits and actually make money out of it, or bonds, of course you're going to put your money in the stock market. So that's why all of these P ratios, especially for the tech industry, they're quite inflated. So
Yep.
again, let's say giving both the growth rates of 9% and the P ratio, the projected P ratio for around 30, is very generous. Very generous, I would say.
Yeah. So then we continue to the required rate of return. We can do this whole, speech again. But basically, if you want to invest in S&P 500, you would expect between 7 and 10% annual returns. But because you're stock picking, you want to have some kind of, not margin of safety, but you want to have an extra bonus because you're taking on extra risk. So in this case, we normally put this at around 12%. That's the added bonus for you for picking the stock.
Yeah,
And then for the
11 to
margin,
12, yeah.
for the margin of safety, we normally put this around 20 to 30%, depending on how well you know this business. You can also, if this is not really a risky investment, you can also put this down to, for example, 10%. But it's basically for you to know, like, to what extent is this stock under or overvalued, depending on how much safety you want to build into it. So you want to do like 15 or 20%?
To be honest, yeah, I would even say 30, but let's put it like that. If we consider Apple being, quite a cash cow, the well-known brand and yada yada yada, you could, shave off a few percent, for the safety. So let's put 15. Let's just check. I'm also curious. Yeah.
All right. And then we hit the nice analyze button.
Yeah. And what do we see?
We see quiet the overvaluation. So the
Yeah.
current price is it's not 212, it's 209, or is it? Oh wait, the market's open. Yeah, it's 209 as we speak.
Yeah.
Yeah, target buy price of $84.33, taking into account your margin of safety. So yeah, based on our assumptions, it would be a pass. But of course, if you want to pay a 200%, coupon on it, then yeah, you do
Yeah.
you. But for us, this is quite clear.
Yeah, and then it also makes sense, to be honest, why Warren Buffett also sells it. It's not only about, let's say, the business model, it's not about just the growth prospects, but it's just expensive. So it goes both ways. It makes sense to actually sell quite a lot of it just to enjoy, all the profits you made over the years, and, rightfully so. But on the other hand, yeah, Warren Buffett would also not sell the stock if he doesn't see the future in it, because you're gonna sell. You buy for one reason, and you always say, right, to make money, but you can sell for many other reasons.
Yep.
And yeah, if he piles up cash for buying something else, it completely makes sense. But it's definitely not Apple at this moment. So yeah, keep in mind, guys.
Yeah. All right. And again, as we have not been launched as of this moment, we still cannot tell you where to get this app, but it will probably somewhere on 930.com in the future. But the best thing for you to do, if you want to keep updates on when our web app will release, best thing you can do is just subscribe, push the bell button, and follow us on other social media platforms such as Instagram. And with that said, Kirill, thank you for being here and with your lovely insights. And then we'll see you in the next video.
Likewise, take care. Bye bye.